Hey folks, Michael Lush here. See a lot of comments in our YouTube feed and our YouTube channel. And some of the comments, it's very clear that a lot of folks are confusing a second lien position home equity line of credit with a first lien position home equity line of credit. So I wanted to put together a very quick and dirty PowerPoint presentation just to dispel some myths and some concerns and also some confusion regarding a first lien position home equity line of credit with a second lien position home equity line of credit. So let's get started. I want to talk about understanding the differences between the two. And as simple as I can possibly put it, it is just a refinance. No different than if you were refinancing your FHA loan to a conventional loan in order to eliminate your mortgage insurance. It's no different. It's actually the exact same transaction. So let's get into it. All right. So, first, let's talk second. Traditionally, folks think of a HELOC in second lien position. Heck, even bankers think of it that way. However, a HELOC does not have to be in second lien position, but I will show you what you probably already know about second lien position home equity lines of credit. So here's a traditional home equity line of credit. Let's say you have a home valued at $300,000, and let's assume you owe $200,000. That's $100,000 of equity, correct? But the bank will give you 80% financing of the value. So that's $240,000. So that banker would structure a $40,000 HELOC on top of your existing mortgage of $200,000. So let's look at it visually. Home values 300,000, 300,000 at 80%. So you just do 300,000 times 0.8, and that's going to get you 240,000. Now you owe 200,000, so you're going to take your 240 minus your 200, and that's going to leave 40,000 left over. So you're probably asking a question, but how am I paying off my mortgage with $40,000? You're not. It's that simple. You are not. That is a second lien position home equity line of credit, not a first lien position home equity line of credit. So that's one of the issues with second lien position HELOCs. You will now have a HELOC payment on top of your mortgage payment, causing what I call segregation of income, which slows down the process. Still efficient, still better than doing nothing. It's better than doing biweekly payments. It's better than actually paying extra on your mortgage, but it is still slower than first lien position because you have what's called segregation of income. So even if you use the HELOC to pay down the principal of the mortgage payment does not change until you refinance it, right? So the payment is still the same. So you didn't really improve your cash flow positivity. So not to mention the HELOC bank is in second lien position, which is much riskier than in first lien position. I'll get into more of that here in a little bit. So first lien position home equity line of credit. Replace Your Mortgage advocates first lien position HELOCs. So let's not complicate this. It is a simple refinance. Have you ever refinanced your existing mortgage? So it's the exact same process. I mean, appraisal. The documents are a little different because it's a different loan type. It's a home equity line of credit and it's bank secured as opposed to government insured. So you're going to have different documents. You're going to have fewer documents. You're going to have fewer closing costs, but it's the exact same transaction. So, for example, many folks will refinance their FHA loan into a conventional mortgage. A lot of folks will do that because on an FHA loan, you're going to have mortgage insurance. So, if you have 20+% equity, really 22, then you can refinance to a conventional mortgage and your mortgage insurance will fall off. So, mortgage insurance doesn't benefit you at all. A lot of folks think or confuse that with mortgage protection insurance, and it's not the same. We're talking about mortgage insurance. Actually, none of that goes towards your principal or interest, nor does it insure you or protect you. So that is what most refinance transactions look like when folks are refinancing from either an FHA or a USDA loan or what have you to a Fannie Mae or Freddie Mac loan. This is going to be the exact same process. So instead of refinancing your mortgage to another mortgage, you're going to refinance it from a mortgage to a home equity line of credit. So instead of refinancing your mortgage to another one, I just mentioned that. Now you're just going to refinance it into a home equity line of credit. So here's what that looks like. Let's say the home value again is $300,000, and you've got a mortgage balance of $200,000. 80% financing. Again, we get 240. Math doesn't change. Now you have a HELOC with a balance of 200,000, and you have a credit limit of up to 240. So you have an additional 40,000 available. So all you did was change the nature of your debt. You changed it from a mortgage to a simple interest line of credit that has a limit of an additional $40,000. Now, again, you only pay interest on the balance. So keep in mind, if you haven't used that additional 40,000 and all you've used up until this point is 200,000, then that's all you're paying interest on. This is different than a mortgage. If you got a mortgage for 240,000, day one, you're going to start paying interest on 240,000, not 200. This is a simple interest line of credit. So you're only going to pay interest on the balance that you have used, and you do not pay interest on the amount that you have not used. So in this example, you are not paying interest on 240. You're only going to be paying interest on 200,000. So let's talk risk. A HELOC in second lien position can be very risky. The bank technically has no guarantee of repayment in the event of default. After all, they are behind your mortgage lender. Have you heard of anyone talking about banks freezing HELOCs during the last real estate meltdown of 2008? They were predominantly in second lien position. That was also predominantly in very riskier markets, Vegas, Memphis, Atlanta, Miami, and so on. So lots of default and foreclosures. And if they had a HELOC and the markets were plummeting, then those banks were freezing lines of credits. Now, it wasn't across the board. It wasn't nationwide. You had to be basically in default in order for them to freeze it, and your value of your home had to massively decline. And that's why they would freeze it, because you're in second lien position. They're not guaranteed to get a penny if you default. In first lien position, the bank is guaranteed collateral rights in the event that you do default. So there's no one in front of them. So this reduces the risk to the bank. And when you reduce the risk to the bank, you reduce the risk to yourself. So if you want to learn more, we charge $0 for a consultation to determine if a HELOC is right for you. And I'll promise you, we won't move forward unless it's the right fit for you, because this is not for everyone. In fact, it's not for most people. You have to be cash flow positive and you have to have some discipline. So here are the requirements. You have to have 20% equity. You have to have a 680 plus credit score or higher. And again, you have to be cash flow positive. What that means is you have more money coming in than you have going out in expenses. So here's the website, and I'm also going to put it in the comment section. Go to replaceyourmortgage.com/discover and book your free consultation today. Take care. God bless.